Hey, good morning, everybody. It's Hammer. Today is Wednesday, October 29th, 2025. Welcome to Hammer Live. That didn't work out so well. Anyway, good morning, y'all. Great to have you here. My name is Hammer. I am the founder of Originator Success, Grab and Go Social, and Rate Sensei. You can find out more about those online. Remember, you can join me live each and every weekday morning, 9:30 a.m. Eastern Time, broadcasted to you on Facebook and on YouTube. If you're here this morning, say good morning. If you're watching on the replay, don't forget, all I ask is that you give me hashtag replay in the comments. Let me know that you were here. Today, we're going to be talking all about the Fed. And then we'll probably talk a little bit about the Fed, and we'll wrap up talking about the Fed. So it is Fed Day, and probably even a more important Fed Day than normal. So there's some interesting things about how rates could go. We're going to talk about where rates are going after this Fed meeting and the possibilities. Right now, the possibilities are endless. They're limitless. So remember, if you like the show, you want to join me live each morning, you'd like a reminder to your cell phone, go ahead and sign up for our text reminders, hmmr.io/reminder, or use this cool QR code over here. If you're on your phone right now, you can take a screenshot, go back to your photos, and that QR code will still work. They've really come a long way. Y'all know I love these QR codes. So anyway, also, if you would like to sign up for our written email lock advice we send out each and every weekday morning, www.ratelockadvice.com. It's a handy dandy email, let you know what our lock advice is, along with some commentary for that. And on days like today, it's important to stay alert. Make sure you are signed up for our text alerts. They are a whopping $7 a month, no tariffs. www.ratetextalerts.com, or use this cool QR code over here and you can get signed up for those. Ratetextalerts.com. We send out a morning text around 10 a.m. Eastern Time, and afternoon text around 4 to 5 p.m. Eastern Time. And on days like today, we'll be sending out a bunch in the middle, telling you what's going on with the Fed meeting. So if you want to stay tuned with what's up with the Fed, that is how you'll want to go ahead and do that. So I'm even going to leave that down at the bottom with the sign-up link so that you guys know where to find it. So let's go ahead and say hi to all the live folks here this morning. What do we got going on? Good morning, y'all. So great to have you here. So many of you. And that's right, Ron. My wife told me today was National Cat Day. Today is National Cat Day. For those of you that don't know, my wife volunteers at Feline Urgent Rescue here in Western North Carolina. It's a cat sanctuary. It's a no-kill cat sanctuary. And they adopt out, usually, man, they adopt out crazy numbers of cats. I think probably like close to 100 a year or more. Maybe that's even low. They adopt out a bunch, but they've got about 80 cats at the place. So, and of course I have Sophia and George. Where's George? George is running around today. Sophia's up here being lazy. So good morning, y'all. And let's go ahead and see. We got Deb Dickinson. Good morning. Megan Bissell, Mallory Fotiadis. Great to have all of you here. By the way, how many of you, if you went to Fuse, let me know in the comments and let me know what you thought of it. That's awesome. And Ron said, can you help me convert that odd time to the real time in Calizuela? Nah, yeah, hey, at least you're not in Arizona. They're even worse. Bill Stevens, good morning. Michael Scott Love, Tim Klyla, Vicky McSweeney, Hojo the L.O., Holly Johnson, Tiffany Teal, Lending by Angela. I wish they would fix these because it's kind of hard to do that. Almir, good morning. Rob Stewart, Allison Foy, Sean Segaloff, Brandy Brickler, Candido Diaz, Mike Brown, Randy Tico. Giddy up, sir. Jerry Avila, great to have you there. Candido Diaz, good morning. So Sean Segaloff, rates will be great today. I locked yesterday. Why did you lock yesterday, dude? out of all the days to lock. Why? I mean, like, was the loan closing so you had to lock? Otherwise, why lock? Because we could see things go to that next level. We'll talk a little bit more about that. So, Siegel, you're dating yourself with that line. Georgia of the jungle, threat to you and me. All right, let's go ahead and let's get started. Jump into the good stuff here, and I'll show you where we're at, what we got going on. We're going to go ahead and let's start off with the technicals. So taking a look at the technicals here, you can see a few things that are going to pop out to us. Number one, mortgage-backed securities are currently down 3 basis points on the morning, but that's really not a big deal. Look at the number ahead of that, 101.39. 101.39. That's important because remember, I was talking about 101.29 being a level of resistance. It was stopping bonds from improving. So remember, mortgage-backed securities on this side, when they go up, that's green. Green is good. Green is money in your borrower's pocket, and that is a good thing. So we were right around this 101.29 level that we were just really kind of holding at right here. You can see we've broke above that. Now, if we were only looking at technicals, this would be fantastic. We'd be really, really, really excited about this. However, today we have the Fed meeting, so the technicals going to take a lot more of a back seat very soon to whatever happens today. So, but we are going to we want to be aware of this and where things are at here. Also, taking a look at where the 10-year treasury is, staying below that 4% mark, 3.99 at the moment, 3.99. Now, it's possible today we could see this get down as low as 3.85. That would be a really, really big move. But if we see it get down to around 3.85, that is going to kick open the door for mortgage-backed securities to move up higher. And it's going to help us get those rates into that 5.99 mark that we've kind of talked about before. So quick recap of what happened yesterday. And actually, let's do this on a 5-day because, again, Matt Graham on Monday talked about that it was the treasury auctions that led to the improvement. And I told you yesterday that I didn't necessarily concur with that. I felt that this was more of a drifting and positional. And we saw that continue yesterday, everything right here. Bonds started the day lower, ended the day higher. Not enough to see any reprices better, but look at where we were. 101.23 ending yesterday around 101.43. There's a 20 basis point improvement there. That is a big old smiley face event when you see that kind of movement on where we were at. So definitely going to see some stuff going on there. Now, that's right. Sean said he had to save a deal, have to close in less than 2 weeks and needed the CD. Yeah, so you got to lock that deal. Okay, that makes sense. And the let's see, mortgage dogs. I hate this new thing because I'm sorry if I don't remember who's what on who is this? Who's my friend here? I can't tell who Mortgage Dogs is, but yes, rates went up after the past 2 Fed meetings. That is absolutely true, and in fact, that is what I am currently writing about on the. I haven't sent out the morning text, the morning commentary yet, but you're absolutely right. Today's rate sheets should match yesterday's. Certainly isn't a bad thing since most rate sheets yesterday were the best we've seen since September. Not by much, but still a win is a win. And I say it's not by much because we were at 6.17 and this puts us at 6.13. So not really a tremendous amount, but it is better. After watching rates cap out for a while last week. The catch, the best pricing in September was right before the Fed meeting when the Fed cut rates and mortgage rates moved higher following the cut. So yes, we definitely need to be aware of that. We're going to talk about why that happened and why that could happen again. That also happened in September 24, although rates jumped much higher for different reasons. That was due to the election. Anyway, repricers today is high. Need to be on guard for the signals that bonds give us today. Remember, it's not just what the Fed does and what Fed Chair Jerome Powell says at his press conference. It's how traders and markets react to it. So, of course, everything that's of merit is right here. The Fed meeting concludes today with a policy statement at 2 p.m. Eastern time. Powell's press conference starts at 2:30 p.m. Eastern time. Now, let's take a look. Let me move this back over to here. Hold on a minute. I'm going to pop this back up there. Okay. So looking here, and thank you, Tammy. So it's Tammy Metzger. So Tammy, very good point about this. And let's go into this. So I had this chart ready for that exact conversation. So taking a look here, last September, we peaked right before the Fed meeting. It was the best rates that we saw. And then following that, remember, it was a 50 basis point rate cut. This was back in 24. So it was a 50 basis point rate cut. And we saw bonds fall, which works pricing. And then we saw a huge drop. All of this was more because of the Trump effect and the elections. But what we saw happen immediately after the Fed meeting is there. We also, let's look at September of this year, and same thing happened. The Fed meeting was on September 17th, and then we capped out. We were at our best levels right here. And then following that Fed rate cut, things went down and we lost ground, lost pricing. What does that actually look like on rate sheets? It looks kind of like this. Hold on. This is too much of a time frame. Let's pop it back to over here. So looking back on 24 September, right here, best rates. And then hold on. There you go. That makes it a little bigger. So here we were, September of 20. It wasn't September. It was September of 24 is right there. And then same thing happened here in September of 25. And you could see that if we, let's crimp this up a little bit. You could see that we had that one day of really, really great rates right there. After the meeting popped up, and then we kind of stayed up a little bit. Wasn't a huge jump. You're talking about 6.6 1/8. Rates were probably about 6 1/8, and they jumped up to 6 3/8. Maybe, so you're looking at a quarter point roughly of an increase that occurred after the meeting, but then they came back down again. Everything has variables on why it happens. Now, what could happen this time and why? Let's go into some of that detail here. If we take a look, what to watch for as the Fed meets this time, markets currently pricing in expectations 99.9% that we're going to see a Fed rate cut, right? Markets are absolutely, but look what happened for December. December has gone down. It was 85. It's up a little bit to 87 now. But remember, we were at 95% a week ago. Right here was 95%. Then we were at 90% right here. Now we're down to about 85%. We're seeing a move lower in expectations of a cut in December. So that's what's basically, we're seeing some doubt creep in amongst investors about if we'll see a December cut. It's still very highly expected, 87% at the moment. However, you've seen a gradual increase in expectation that the Fed funds rate will stay the same at that December meeting. Same thing when we get into January. A week ago, expectations were up to almost 60% that we'd have a rate cut. Now they're down to 45%. So we've seen a 15% drop in probability of a rate cut here at the January meeting as well. So it's going to depend on what Powell has to say and what things happen in the press conference. Markets are absolutely pricing in the idea that we're going to get a quarter point cut. The Fed is going to deliver a quarter point cut. There's no question there. The question becomes more of where are we on the forecast? So according to Tim Ross here in kind of a nice summary, divided forecasts, and in September, a narrow majority of officials thought 2 more cuts this year might be warranted. Remember, we got the dot plot. So that was the expectation. There was an also significant minority of officials didn't think further cuts after last month would be appropriate. And if you remember, the way the dot plot reads, it was kind of odd because the dot plot goes a lot. You've got a lot that thought we would end at 3.5. Then there were only a couple that thought we would see 2 cuts. and then a lot more that felt that we just needed to see the one cut in September and then stop. So this is after September. This is just that one September cut. This is 2, and this is 3. So a lot of the members thought we would see 3. Very few thought we would only see 2. So we're going to get that second cut today. Obviously anybody that was in this camp is now forced into this camp to see here. So, but it shows you how split that the Fed is over this actual rate cut. Data drought. Normally, economic reports that shade the outlook in between the Fed meetings help reconcile any divisions. The lack of new labor market indicators in particular has robbed officials. Decisions for December. The data blackout could give Powell an easy way to sidestep questions over how officials are approaching the next set of decisions. Now, normally he would say, well, it's data dependent, but what are they going to do when there's no data? The lack of timely and comprehensive data means they haven't learned that much since September, and that leaves them presumably closer to where they were in September, but with wider bands around it, according to William English, former senior Fed advisor. Powell has acknowledged there's no risk-free path. Officials are caught between cutting rates more than necessary and spurring stronger activity. Now, this is the part that could help mortgage bonds today. The end of the portfolio runoff. Officials are also likely to discuss when to wrap up the reduction of the Fed's $6.6 trillion asset portfolio. Many analysts say it would be warranted given signs that various overnight lending rates have begun to trade closer to the top of the range for the Fed's benchmark federal funds rate, currently between 4 and 4.25. So although we always talk about it as if it's only a single rate, it is a range that they can trade, they can basically charge anything between 4 and 4.25. So there's always that quarter point range, and it's trading at the top of the range right now. This was also some interesting things that we didn't really talk about. First things first, the Fed lost access to private jobs data ahead of the government shutdown. Payroll processing firm ADP ended its data sharing with the central bank. That was a bit of a weird one, especially because with no BLS jobs data. So this is, ADP stopped providing its data to the Fed shortly after a speech by Fed Governor Christopher Waller late August drew attention to the central bank's longstanding use of its weekly payroll data. It couldn't be learned what prompted the change. The Fed's use of ADP data wasn't a new revelation. And then Elizabeth Warren, who I am not a fan of. I don't like Elizabeth Warren. I don't say negative things, and I don't wish her any ill will, but I don't like her as a politician. I don't necessarily, her views don't jive with mine. She wants to know why they did it. And, without federal economic data, the Fed is flying blind. Warren said in a letter asking for more information on their decision. They're a private company. They don't have to share with the Fed. So, but who knows, she'll overstep bounds whenever she wants. She's as bad as anybody else. So we'll see about that. The other thing that is worth noting and talking about is right here. The Fed's $6.6 trillion test, when to end the portfolio runoff. The 3-year bid to shrink its assets. Remember, they call this balance sheet runoff, but it's quantitative tightening is what it is. It's the opposite of quantitative easing. Quantitative easing, the government buys up bonds. That helps keep the price of bonds higher. It increases demand. So therefore, it helps shore up our markets. Quantitative tightening, they're selling off those bonds, which then pressures the supply side, which drives the price lower, which means worse pricing for mortgage rates. So Federal Reserve officials have a suddenly pressing decision when they meet this week. Nothing to do with an interest rate cut. It's whether to stop shrinking the central bank's $6.6 trillion asset portfolio within days or wait until the end of the year. So that's kind of what we'll see happen. If they do stop with the balance sheet runoff, that could help us a little bit. It could help bonds a little bit. But overall, when we look at where pricing is going to go, where things are going to go, we have to be prepared. And right now, again, we're cautiously floating. Let me pop this up on the here. So we are cautiously floating. It's down on the bottom. We're going to float into the meeting and read the room. And depending on how mortgage bonds react to this news today, we will see which direction are we looking to kind of go. If it looks like it's possible that bonds will continue to move higher, they tested back in September. It was right around 101.60, 101.64. See it right here. Let me see if I can get it to. So 101.64, 53, 101.64. That was where they tested the highs. Oh, you guys aren't seeing that. Hold on a minute. Let me change to this. There you go. So over here is where I'm looking. If you look, it's like 101.64 was the highs, and right now we are at 101.38ish. So we would have room to push up higher before we would test where we were back at the previous September and those best levels. And if we could continue to see some improvement. Now, again, we're not likely to see rates continue to drop. You're not going to see rates push down into the low fives, but if we do see improvement in bonds, you're going to see lenders that are going to definitely stretch margins. They want to price at 5.99, 5, and 5.875. They want to get into the fives. Anything with a 5 handle is going to spur activity with consumers. Be ready for it. This is one of those windows. We don't know. Today could be one of the best days to lock rates. Have things available, float into the meeting, read the room, see where you think things are going to go from there. Let's see. Randy asked, yeah, that quarter was a huge hit for refi loans. Which quarter? I don't know which quarter. When it jumped afterwards? Yeah, absolutely. You are welcome, Peter Riley, for all the insight. Randy said, what was the Fed balance sheet prior to COVID or at the height of COVID? I don't know. We have to Google it and see. Ron Siegel, do you know on that one? You tend to really follow that stuff pretty tightly. Let's see if it's in the article here. I mean, they talk about 6.6 trillion asset portfolio, but I don't know when that was. But if we take a look here, their asset holdings, this should give us the answer. So it looks like it was right around 9 trillion was the highest levels here. As you can tell, of course, this moved up during COVID. COVID was right here, and then they bought like crazy. So it looks like it was right around $9 trillion. And then it's been moving low. Remember, this was that regional thing going on for a little while. And then it's been dropping. I mean, now they're down to 6.6 trillion, 6.59 trillion. And that was more. Now in 2018, they were only around 4.5 trillion. And then that was actually sold down a little bit. And then it jumped right here is when COVID started. So they went from 4.16 and then all the way up to 9. I mean, they basically doubled the amount of holdings. So they're still much, much higher, to answer your question, Brandy, that they are. I mean, look at this. They're still in between the highest level and where they were, but they're still pretty much in the middle of that. So still very high for sure. Two separate questions. The quarter point, what was the balance sheet prior to COVID at the height of COVID? So we got both of those. Yeah, Ron said prior to COVID, 4.2, and that's what we're seeing right here. 4.45 dropped all the way down to 3.76, worked its way up to about 4.2 area, like what Ron was saying, and then as COVID came out, it popped up. So we're right in that range right there for that. So, all right, well, everybody, that's 20 minutes. Let's wrap it up. I'll see you guys tomorrow. We'll get together. We'll talk about what happened after the Fed, where rates are. We'll have a much clearer idea. Remember, if you're not already signed up, go sign up for our text alerts at ratetextalerts.com. They're $7 a month to keep you posted, protect your pipeline. Also, get more insight with our lock advice at ratelockadvice.com. Also, go check out Grab and Go Social. Grab and Go Social is we're still doing the $7 promo for a while, so you can get signed up for $7. And here, let me pop it on here. Go check out grabandgosocial.com, and you can get signed up for $7 and get some awesome content through all these kinds of things. Remember, don't argue with consumers about the Fed rate cut and mortgage rates unless we see rates go up. If rates come down on the expectation that things could improve in the further, you don't have to clarify why. Just write loans, baby. Write loans. So we'll talk more about that tomorrow. We'll see where we're at. All right, everybody. Vicky McSweeney, you're welcome. Thank you, everybody, for joining me. I'll see you guys tomorrow, and we'll talk about what happened. Take care, everybody. Bye-bye.